Let's get to the markets right now. Joining us is Mark Grant. He's Chief Global Market Strategist at B. Riley FBR. And Mark, I've been thinking about you as we've been watching yields rise in the bond market, and for treasuries, I should say, specifically. As we watch the 10-year kind of creep back up this morning, it's above 1.36%. I mean, those are levels we haven't seen in a really long time. And I know that historically speaking, it's not much. But is there anything happening here that's starting to make you rethink your stance on the bonds?
Well, Becky, you're 100% correct. It's creeping up. You know, the CPI indicates an inflation rate of 1.4, so treasuries are still less. In other words, you're getting a negative return in treasuries. But to me, is some of the most interesting things, Becky, are that the high yield market, for instance, it's about its lowest level, right off its lowest level in a decade. We're seeing corporate bonds tighten to treasuries. So we're seeing treasury yields heading up and everything else, the risk credit yields heading down. And there's very little appreciation of credit risk, for instance. And it's a very interesting time in the bond markets, which is why, as you know, I've suggested looking at closed-end funds and some ETFs where you can get much higher yields, some double-digit yields, as opposed to straight bonds currently, which have almost no return.
I know you've got a new piece out this morning kind of reiterating some of those thoughts on ETFs and closed-end funds. It's not something that's very sexy. It's not something that a lot of people focus on. What is it that you'd like people to kind of pay attention to that maybe they're missing?
Oh, you're right, Becky. It's not sexy at all. I think everybody's portfolio, whether it's an individual, a senior, a pension fund, a university endowment, should have two components, two basic components. One is playing for appreciation, which is the sexy stuff you talk about on Squawk Box all the time. The second, which is not sexy, is yield, which is some of these closed-end funds, Becky, as I said, you can get double-digit returns, and a number of them pay monthly, some quarterly. So it gives you a cash flow and a yield component of your investment strategy, which I think is very important. Not sexy, true, not sexy, but I think it's very important, especially as people start getting a little older here.
Also, not all created equally. You point out that price, as with everything, the thing you really have to pay attention to, and you specifically say watch out for some of those that are priced higher than their net asset value.
Right. I don't think anybody should buy any of these funds, either the exchange-traded funds or the closed-end funds, you know, if they're appreciably over their net asset value. What it means to explain it to your viewers, it means you're paying, say, if it's 5% over, you're paying $1.05 for $1 worth of goods, which makes no sense. What gets very interesting, and these funds are complicated, not sexy, but complicated. If you can buy stuff at 93 cents on the dollar and you're getting $1 worth of goods, and you've got a bunch of good assets in the portfolio, whether it's bonds, convertible bonds, equities, or numbers of different sectors that these funds cover, then you're in great shape. Obviously, if you can pay 92 cents for $1 worth of stuff, you know, you're doing well. And some of these, like the equity funds in some of these funds, have like Amazon and Google and all kinds of high-profile growth names, and you're still getting this outsized dividend. So I think they're very attractive.
Hey, Mark, you mentioned the price of inflation at 1.4%. Do you think inflation is going to push significantly higher?
No, Becky, I don't. And I think what's going to happen eventually, not today or tomorrow, but eventually, is the Fed is probably going to come back in and lower rates again. And the reason I think they're going to do this is there's going to be tremendous pressure put on during these stimulus packages to keep the rates of the United States government, the amount of interest that's paid, low. And if you look at Europe, you look at Japan, Switzerland, all kinds of places, they have negative interest rates. I don't know if we're going to go there. But the other thing, when we talk, for instance, about the 10-year, which is kind of the bellwether, which you were referencing earlier, if you look at shorter rates, even in the United States, they're, you know, just off of zero. And I think the Fed may get more active in here as the government under the new Biden administration proposes more stimulus measures. So I think it's going to be a very interesting political play that we're going to be facing.
Shepard Smith here. Thanks for watching CNBC on YouTube.